Equipment and Supply and its team members are excited to continue our educational platforms and bring more value to our clients. Today's webinar is intriguing as we have two outstanding professionals, Mike Gumbleton and Andrew Kowalski, to review year-end considerations for you to evaluate and what the banking industry's perspective on market and banks are doing today. I do want to mention that neither Mike, Andy, me, or Modern Ice know about any of your specific financial situations. This webinar is presented to inspire thoughts and give you insights for you to take to your personal financial advisors to determine what is best for your specific situation. We are only sharing ideas, not making specific recommendations. A couple of updates on what Modern Ice team is working on for you. We are in the midst of analyzing packaging costs and resin market with our clients and strategic suppliers. Please contact any of our business development managers and/or inside team to help you. Additionally, we have many projects started for this next ice season, and some manufacturer lead times are starting to extend. Let us help you get into the right position. We are here to serve you. Let me take a minute to talk about our logistics for today's webinar. You can see and/or hear us, but we cannot hear or see you. But that's okay because there's an opportunity to chat or ask questions. You'll notice on this slide, in the bottom right-hand screen of yours, you can have the opportunity to chat and put a question out there or ask any questions as we go through. And at the end of the webinar, we will go through and address as many of those questions as we have time for. Additionally, at the end, again, a Q&A session will end and a link to the recording of the webinar will be sent to you immediately following this webinar. Today, again, we have two great presenters to talk on our topic, exploring financial benefits you may be missing. Our first presenter, Mike Gumbleton, is joining us from Michael J. Gumbleton CPA and Company. Mike started in the accounting world working for a large accounting firm, which he left to start a firm of his own. In doing this, he's been able to work with many entrepreneurial clients. Mike's experience and guidance, coupled with his deep integrity, has brought his clients extraordinary value. Our next presenter is Andrew Kowalski. Andy works as Vice President of Fifth Third Bank, headquartered here in Cincinnati, Ohio. Fifth Third Bank is in the top 15 largest banks in the U.S. Andy is an outstanding lender as he has been an entrepreneur and a banker. The ability as a banker to have sat in our seats and help with banking insights is invaluable. Thank you both for joining us today. Mike, it is close to year end and we all look to mitigate our tax exposure. What are the suggested tools and/or thoughts you may offer our clients to discuss with their financial planners?
Thanks, Gary. There's a couple topics I wanted to discuss. The first is incentives for fixed asset purchases. The tax law provides many alternatives for writing off capital expenditures. And as you probably know, Congress uses this area of the tax law a lot to encourage capital investment and to reduce business income taxes. The first area I wanted to discuss is the de minimis expensing safe harbor. A taxpayer who elects this safe harbor does not have to capitalize any amount for the acquisition of a unit of personal property that costs no more than a specified amount up to $2,500. Different rules would apply if you have audited financial statements. These items are not capitalized but are immediately expensed. An example of this would be if you bought 20 laptops or 20 pieces of equipment that each cost $2,000, the entire $40,000 could be written off and not set up as a fixed asset. The second item I wanted to talk about was what's called the Section 179 expense election. Generally, taxpayers may elect to expense the cost of tangible personal property, which is new or used, which is depreciable and which is used in an active conduct of a trade or business. For 2020, the maximum amount allowed is $1,040,000. And this is reduced over, it can be reduced if you have a lot of fixed asset additions. There's also a limitation on this whereby it cannot exceed your taxable income. The amount of taxable income that they consider is the amount derived from the taxpayer's active conduct of a trade or business during the year. And it also includes salary and wages from your employment. So in other words, again, you cannot expense more than your business taxable income. The other interesting newer provision is now, it used to be only for tangible personal property, but now it's expanded to include roofs, HVAC systems, fire protection systems, alarm systems, and security systems. So it's not just tangible personal property anymore. The last item I wanted to discuss under this topic is called bonus depreciation. That was set up a couple years ago. And for 2020, 100% bonus depreciation is allowed for both new and used business property that has a depreciable life of 20 years or less. This provision is more beneficial in that there are no limitations on the amount of deduction with respect to taxable income. In other words, you can use this provision to create a loss if that's beneficial to you. And then additionally, a law was passed in early this year to allow what is called qualified improvement property. This is generally interior improvements to non-residential real property. These are now eligible for bonus depreciation. So in summary, in each of the above provisions that I've discussed, it allows you to immediately deduct the entire cost of your fixed asset addition. The next topic I wanted to talk about is the Paycheck Protection Program tax issue. Most businesses have obtained PPP loans during 2020, and these loans are eligible for a partial or complete forgiveness if the loans were spent on payroll costs or other qualified costs during the taxpayer's covered period. Several tax issues revolve around the Paycheck Protection Program for 2020 and 2021. The first question is the forgiveness of the loan taxable income? And no, it is very clear the law provides that this forgiveness is not federal taxable income. Normally, debt forgiveness is considered taxable income, but this is specifically excluded. However, states could have different rules, so you should be aware of each of your states as to how they're treating PPP forgiveness. The next question is, are the expenses tax deductible that the loan was used to pay for if the loan is ultimately forgiven? The IRS in a notice came out in late April that states that no tax deduction is allowed for any expense that is otherwise deductible if the payment of the expense resulted in a PPP debt forgiveness. Currently, there's strong bipartisan support for legislation that would clarify that the receipt and forgiveness of coronavirus assistance through the PPP program does not affect the deductibility of ordinary business expenses. So if legislation is passed, it would then allow businesses to write off their expenses and override the IRS pronouncement. But right now, it's very unclear when and if such legislation would be enacted. From what we hear, there was probably no chance that a standalone bill would be passed to allow this, but this would be attached to a larger bill. And as I'm sure you've heard, there's much debate going on between the different houses of Congress and the White House as to the size of another bill to assist taxpayers and businesses. But from what we hear, it's just a question of if, not when, such a bill will be passed, and there's very strong support for allowing these expenses to be deducted. The last question is, what would happen if you have the expenses in 2020, but you don't get your loan forgiveness until 2021? Right now, there's been no guidance issued by the IRS concerning this treatment if these end up in different years. From what we hear, it sounds like the IRS is about to issue guidance that will say if there's a high likelihood that your loan will be forgiven, then you cannot deduct the 2020 expenses unless legislation is enacted. The last topic I wanted to discuss was year-end tax projections. And we would strongly tell you to consider doing both a 2020 and a 2021 tax projection. So you can see your income levels and potential tax rates from each year. There are many factors to consider for this year and next year. First, of course, being the COVID-19 pandemic. The second being the resulting economic downturn in the recovery that's occurring. Thirdly, the elections could have an effect on your projections. It's unclear right now who will control the Senate, and that may dictate what will happen with taxes. If the government is split, then it's a lot less likely that a tax law will be passed. However, if based on Joe Biden's tax plan, it's possible tax rates would increase for higher income tax people if the Senate were to go Democrat. So it's just something to pay attention to over the next couple months. The unfortunate thing is Georgia elections won't be decided until after the first of the year, but pay attention to what happens in the election in your planning. So typically, businesses that don't expect to be in a higher tax bracket next year would want to defer income and accelerate expenses to reduce this year's taxable income. However, based on your circumstances this year, you might actually want to do the opposite, but you need to do projections for both years to see where you might come out. Thank you for your attention. Thank you, Gary.
Mike, thank you. And again, if you have questions on some of the topics that Mike brought up, go ahead and start entering those into the chat, and we'll try to get to all of them at the end. Again, Mike, thank you. Andy, welcome into today's discussions. Our packagized clients have many clients in different market segments that they service. What is the bank seeing in other markets today?
Anecdotally, within the portfolio of myself as others, construction, which I know from my past experience, uses ICE on a lot of job sites and industrial sites, is strong. There's been no slowdown as it comes to the industrial space of construction or the housing and residential space. So strong on both ends there. Commercial obviously is a little bit different based on retail, restaurants, things of that nature. But for the most part, as a whole, construction is strong, and the concern of future backlog toward the end of the year that was present back in the spring and summer has been backfilled. And you had mentioned lead times and orders getting pushed back potentially due to demand as the country opens back up. Same thing has happened in construction, especially for housing. I know in some markets it takes a year to even break ground if you purchase a new home today. Distribution, manufacturing. Once again, anything doing with the housing market is strong in the manufacturing sector. Auto, since there was a shutdown, same issue with the shutdown. Cannot get vehicles to the showroom quick enough. Inventory is low. And one of the things that the fear there is some kind of a supplier shortage to the auto market. Once again, this is all demand driven, lack of supply due to the shutdown. Restaurant is being in the ice market. Supplying restaurants is weak, but groceries are strong. So we have a situation there where you might be hedged if you're in the ice business. Logistics, very, very good, as you may imagine. Everything's being delivered. Not much shopping going on, and the Amazons and the like have seen great uptick in the logistics space. If you just look at thank you, I forgot to move the screen. If you look at UPS, UPS is up on the year. Anything doing in the logistics space is doing well. Bioscience, if you're in the testing markets, obviously those are doing well. And then as you get into the consulting, I don't know how much ICE is done in the consulting world, but another silo here at the bank. Depending on your geographic area, you're pretty well neutral. In some cases, everybody went online. You needed security. You needed the remote logins. That was a boom. But then with the uncertainty of budget cuts, with companies, they're cutting back maybe on their IT spend just because that's one of the things that usually are the first to go in that regard. Moving on to the next slide, we'll talk about credit and what we're seeing in the credit world. Fifth Third, as well as many of the larger banks, are known for having high standards when it comes to credit. So we still are extending credit to strong companies, both existing and new customers, with good balance sheets and income statements. It is noted, many people say, hey, I might not be able to move my current bank because I have a PPP loan. We have seen some exceptions where there are solid companies that have been frustrated with their bank, where we've absorbed that PPP loan and will carry out that process for them from where it stands. Overall, though, the mood is cautious. We're not jumping to take in new companies, just as many companies are not jumping to leave their banks. If there's a lot of trust with the bank, people like to stay put in uncertain times, just like much of anything else. But strong balance sheets are the key. A fortress always helps, and P&L and projections are huge. We really like to see people that can project out at least in some benchmark and baseline, so they can be adapt to the rapidly changing environment. So projections, are case by case. Some aren't always great, but we appreciate the transparency and the acknowledgement of that. And those are the types of customers, obviously, the banks want to deal with. Silence is probably the worst thing that we could have. Covenant modifications. For those of you that have banking arrangements, obviously, you have to report quarterly certain ratios, maybe so your debt doesn't get out of whack to your EBITDA, or you're covering your fixed charges with your cash flow. Those were impacted by a bad quarter in Q2. Even our best companies had to come in and modify, which we have spent a lot of time doing on a trailing 12-month look back, readjust the covenants, because for the next 12 months, there's going to be that gap where there was a bad quarter, and we have to modify those covenants and look forward and reestablish what those ratios are. The PPP, any income recognition we exclude. We don't count that as part of EBITDA. And some customers, and maybe there are some businesses out there that are on this webinar today, may have initially said, well, what do you mean? That's real income. Well, it's real debt too. So if you don't want us to count the debt, we're not going to count the income. So both of those are removed from any analysis. No different than you would see in any other financial analyst would want to get to the core operations of the business. Other items on there I did not have, and Mike had made a mention of it with potential change in tax policy with Blue Wave. We have actually had to modify some covenants for distributions. Obviously, banks don't like seeing a lot of cash leave companies and paid out to owners and individuals. We've actually had to modify some covenants where we say, okay, you were going to do the same distribution in 2021. Well, we're going to double it up in 2020. So you can pay double the distributions out here in 2020, pay a little bit higher of a tax rate versus paying maybe a lot higher of a tax rate in 2021 if the blue wave comes through. Other things that we like to see, once again, transparent communication, as we mentioned, 13-week cash flow. We know it can't be pinpoint accurate, but at least get a baseline so we know the CFOs and controllers out there are looking at variances every week to know where they stand. They don't come back to the bank one day and say, I'm out of money. What do I do? Increase my line. We like to have those conversations ahead of time. Sensitivity analysis, and once again, with that come the covenants. We usually give about a 10% cushion to miss projections in those covenants when we set them to what your forecasts are. Pricing. This has been kind of a wave. I didn't put this on here, but I checked today in our swap markets, and pricing today, actually, given the vaccine that came out yesterday and potential stability in the rise in the markets, pricing went up 10 to 15 basis points today on our base pricing. I checked the cap markets desk. So any kind of security and hopefully calm in the future will bring higher rates, not only to the bank, but also to people's savings accounts and depository relationships. So working back to where we were here, floors were big come March. And what those were is your base rate, in most cases, was LIBOR. And LIBOR a year ago was probably 200 basis points. And in March, they dropped down to about 15 basis points. And I like to do the analogy to a gas station. Price of fuel is pretty much the base rate, and your spread comes when people come in and buy things in the convenience store. Well, that doesn't mean that the gas station doesn't make anything on a gallon of gasoline. They still have some profit margin that's brought in by that base rate. So when rates went down to 15 and could have been headed negative, floors were put in as a precaution across banks. Most of the larger banks were doing that kind of pricing, anywhere from 50 to 100 basis points, given the potential for negative rates. So with that was the base rate. And then we get to the spreads. There was a rush for cash, not as bad as you saw in 08, but there were a lot of people that came and decided to draw down their lines of credit to have cash on hand. And even though the Fed decreased rates and cut rates, the market for rates was actually going up for a little bit because of the rush on cash. So with that rush, spreads were actually higher and they widened. And you could actually get some decent CD rates there back in March and April, and borrow on your line at a cheap rate because you didn't have a floor and have a little bit of arbitrage. Not as strong as it was in 2008, but you still had that opportunity. That opportunity faded quickly, and now spreads have come back in line. They've narrowed a little bit. In the banking market, it's back to competitive again. And the base rate, though, is still low, but most of our clients have had to take on floors. So that's kind of where we've been on rates over the past 6 months or so on the borrowing side. As we get to what you have in cash on your checking accounts, savings accounts, same thing as you see personally. It is almost impossible to earn much in your cash accounts. I know CDs, promotional rates at banks, jumbo CDs, you can barely get 50 to 75 basis points. And those are introductory. They go right back to 10 or 15 basis points once that introductory period is over. So that's what we're seeing on that. Anybody have any other questions?
Andy, thank you very much. Great presentation and insights. If we've had some questions or brought up, we'll put them on the screen here. So I think the first one that I'm seeing come up on my screen is how does a business select the de minimis expensing safe harbor? Mike, how do they do that?
There's basically two things you need to do. One is when you file a tax return, you need to there's a specific election to be made, and you need to do that every year with your tax return. The second thing you should do is draft a capitalization policy that matches up to your election. In other words, if you're going to elect to expense $2,500 per asset, then you would put that in your election, and you would also draft a capitalization policy that mirrors that and keep that in your file in case you get audited. Then you would have both of those.
Okay, thank you. Do we have other questions? What are the state tax effects of these three expensing provisions? Mike, I think that's probably for you also.
Yes, each state is different. You would need to look at your state law to find out what the effects are. But generally speaking, the very first one, the expensing provision, it's just going to be expensed and not even set up as a fixed asset. Generally speaking, most states would follow that, so you would get the write-off for state as well as federal. As far as the bonus depreciation, most states do not allow that. They require you, or they basically make you compute their state depreciation without the bonus election. And I would say most states follow that provision. The Section 179 election, generally, the old law was that you could expense $25,000 a year, well before the $1 million that you can do now. And a lot of states follow the 25,000. They'll let you expense 25,000 for state purposes, but then anything over and above that, they make you depreciate using normal depreciation rates. So again, you need to look at each state and see what they say, but there's definitely different state tax than there is federal on all those provisions.
Thank you. Andy, question for you is, as you talk about, or we talk with a lot of clients who are getting ready to make a presentation to a bank for a capital piece of equipment or expanding their business or whatever it may be. What are some things that they can do to make an effective presentation to a bank? From how do you guys like to see ROIs presented on it, or what are the 2 or 3 key factors that they should be thinking about to present to a banker?
Once again, all comes down to cash flow. The first things we do, we look at 2 things. How much debt is outstanding? How much incremental debt is this new piece of equipment going to add? And what is that going to do to the debt to EBITDA, funded debt to EBITDA ratio? And is it going to make it too highly levered? The bank is comfortable with about 2.5 times funded debt to your EBITDA. 2.5 times is kind of the top area where we feel comfortable, because most covenants are set at about 3 times. If you go over 3 times, the bank looks at it as you've breached covenant. And then the second piece of that is not only funded debt to EBITDA, that's pretty much, where are we on the balance sheet? Then we go over to the income statement, and we like to see, has the prospect or the client been able to model and run through a scenario with, hey, this is about what I think the loan would be at this rate. It's going to add this much principal and interest that I'm going to have to cover each month with my EBITDA. What's my fixed charge cash flow coverage or debt service coverage ratio going to be? Once that helps us a lot. If especially it gives us confidence that that the client knows how to model and cover these issues as they come forward.
And if it follow that question up, if you are more of a startup business and they're looking for an assistance, what are some of the things that a startup type of company are you looking for them to bring with them, other than having some capital opportunity that they can bring?
Okay, so outside of the raw numbers, we like to see, actually I have one sitting right in front of me now, a strategic plan
Okay.
that details the management. You know, what are a SWOT analysis that goes into that? Who are the top customers going to be? Are there contracts involved? The lengths of the contracts, the amounts of the contracts, everything that person does to frame their business to get it going really needs to be on paper in a nice, methodical, organized fashion, and put numbers to the subjectivity of it. So you want to tell the story in the beginning, and then backfill it with the numbers that tell that story to support those claims of, hey, I've got a viable business here. I can make you money. You can make me money. Let's work together.
Okay. And Mike, one last question to you is on when we're looking to buy some things towards year end, an ICE merchandiser would be considered something that they could purchase and use as a deduction this year?
Yes. If it was $2,500 or less, then they could just expense them. If it's more than that, then they could either use bonus depreciation to expense it, or the Section 179 provision, and write them up. The only thing you have to watch is to make sure they're placed in service, meaning that they're ready for use. But other than that, once you buy them and they're ready to be placed in service, you can write off the cost.
And placed in service could be in their warehouse, ready to be put out into use, Mike?
Yes, I think so.
Okay. Well, great. Andy, Mike, we can't thank you enough for being with us today and offering your professional insights to our team and our clients. That is very, very appreciated. So thank you both. I'd also like to remind everybody that a recording of this will be sent to you via your email. So you can use it to watch again later or ask questions. And if you do, there's their contact information if you'd like to contact them, or contact any of our business development managers. Myself, our inside team will be happy to try to get you connected with the right answers. Also, one of our next upcoming webinars will be maximizing your ice maker operation, that we will have two industry gurus to offer some of their insights in preparation for your next season. So we thank you all and appreciate your attending today. Have a great, great day.
Thank you. You too.
Thank you.